All right, there is no way to sugarcoat this. You are at a disadvantage. There's this 3-letter word, this magical thing that the private investment world really likes and makes them really happy, and the average retail trader, not so much. That word, or I guess acronym I should say, is IPOs, initial public offerings. We're going to talk about why and if the retail trader is actually at a disadvantage, they are, and how the tides may be shifting. The retail trader may have access to this infinite money glitch sooner than you think. And we're going to start from the beginning. I know it might sound boring, but it's going to be important to understand and extremely relevant as we make our way through the video. So let's get started. First things first, all of the major currencies across the world are fiat, meaning paper money, not backed by anything of actual value. And so with time, this paper tends to lose its value. As we can see, a cup of coffee has essentially 12x'd over the last 50 years, and that trend is only going to continue. A process we all know, and it makes people really angry: inflation. So we need a way to keep up to maintain the pricing power of the money that we have. So, we can eat and live life. Naturally, a good way to do that in the past and throughout history has been investing in the stock market. The S&P 500, as you can see right here, a collection of the 500 biggest companies based in the United States, has returned about 10% per year. And that easily outpaces inflation. That sits at about 3% in the United States each year. And at this point, investing in the stock market to hopefully maintain the value of your money has never been easier. We all know them. We all love them. Platforms like Robinhood, SoFi, Webull. There are literally endless apps that allow you to buy and trade whatever stocks you prefer. So you can really set yourself up for a prosperous, financially free future, or financially incapacitate yourself with about 3 clicks. Either way, you have the choice. In any case, anybody has the ability to do that, which is great. Investing in public companies. So great, 10% per year, outpacing inflation by about 7%. That's pretty sweet. But what if I told you there's a strategy that doesn't take much thinking at all? In fact, it's actually really simple, that returns over 330x this return per year. About 3,350%. This is not Fugazi. Let me explain. Again, we were just talking about how easy and how accessible it has become to invest in the companies that you want to, the public companies that you want to. You can essentially use any app of your choice. It doesn't matter. Buy the shitty meme stocks that you want. Do whatever. But check this out. Here are some companies that you may be familiar with. Maybe Lyft, Shopify, Rivian, Robinhood, Palantir, Spotify, Twitter, Uber. Maybe some of these ring a bell. Well, at one point, each of these companies were private. So you didn't actually have the ability to invest in them like you would just opening up your Robinhood app, clicking buy, and owning a piece of that company. These are all companies that were previously private, now all public, so you actually can invest and buy however many shares you want. So to give a little more perspective, some of the biggest private companies today, you may have heard SpaceX, valued at $350 billion, and OpenAI, $500 billion. Probably some of the most viral companies just based on the industries that they're in. Space exploration and artificial intelligence, obviously. And so now we're getting into the main point and really exploration of this video. The private sector is essentially an infinite money glitch. All of these companies that we just looked at, ones that you're probably very familiar with, maybe use on a daily, if not hourly basis. These companies all went public, from private to public companies, via an IPO, an initial public offering. Now, there's several different ways that a private company can go public and hence be traded by an individual investor, but the most popular is an IPO. However, what you see on the first day of trading when a company goes public is actually not the same that a private investor sees. 2 recent examples. Figma, a generative AI marketing platform, sold shares of the company privately for $33 a share, and it opened at 85 and hit 100 on the first day of trading. So privately, it was worth $33. Publicly, it was worth 85. Bullish, a cryptocurrency trading platform, sold shares privately for $37 per share, opened at 90 and hit 120 on the first day of trading. So privately, $37, publicly, $90. In other words, private investors got in at a price point that doubled or tripled their money instantaneously. Literally from 1 second to the next. So again, this 10% on the S&P 500 achieved over an entire year was absolutely destroyed on the first day of trading by these IPOs. Yielding investors, private investors, 100 to 200% in one day. Actually, a couple hours. So let's talk about this phenomenon really known as an IPO pop. So let's say a company wants to go public. Their ticker is going to be BBC, British Beer Company. I know you were thinking. BBC wants to test the waters. They want to see, hey, what price should we go public at? Where will we have the best balance of supply and demand? And so BBC consults these institutional investors, these underwriters that help them in this grueling and lengthy process of listing via an IPO. The underwriters say, hey, BBC, we think you should list at $30. This will be the best way to take advantage of all the demand and make for a successful IPO. BBC says, great, let's do it. So private investors buy right here. Let's call that PI. Well, actually PRI for private. Let's say this BBC company, British Beer Company, they don't make beer actually. They make the coolest AI chips the world has ever seen. So everybody wants them. They were originally valued at $3 billion. Now their valuation just tripled to $9 billion. This is going to be $90 up here. So this difference right here, the difference between the private investment price and the actual open, the price that you see on the market when you open up Robinhood or SoFi or whatever brokerage you use, retail doesn't get access to any of this. The stock opens, you can buy and sell up here. These guys, some of them will sell right away, putting selling pressure on the stock, or maybe they'll buy because they think the stock's still undervalued. But either way, what normally happens is something like this. And over the short to medium term, there's a little bit of a downtrend. People want out of these massive profit that they just made. And this really has nothing to do with fundamental long-term value. Eventually, the stock will either find its way back up to those highs or trend back down if it's a flop. Now, this was a 300% gain instantaneously. And I know that 3,300% figure sounds crazy, but I actually found data on this. I'm not BSing. Absolutely ridiculous. So this is the data set that I'm going to refer to. I'll leave a link to it in the description. But it's essentially just a collection of all the varying IPO performances on the very first day of being listed from 1980 to 2024. So we'll be using this proceeds weighted average return. In other words, the bigger the IPO, the more that they're going to be weighted into this average. And just think of this number, the average percentage gained or lost after one day trading that IPO. So I mean, yeah, you can see this chart looks pretty good. Probably comparable to the returns that the S&P 500, the overall market index that most people invest in, returns on a yearly basis. This is one day. Speaking of the S&P 500, if we look at this chart here, we can see that, yeah, it lines up pretty well. We have the average one-day return of investing in IPOs in blue and the S&P 500 annualized return in red. And one thing you'll notice is that blue actually never goes negative. In fact, there's never been a year since 1980, so almost 50 years, where the one-day return of an IPO was negative. Yes, that's right. So what would this graph look like if you traded every single IPO for the entire year and achieved that average return? Well, you can see, you don't even see the S&P 500 because this chart averages about 3,300%. And I mean, even on the low ends, we have, 1,000%. You can barely see this blue bar, and you Forex your money that year. One of the biggest years at the peak of the dot-com bubble. We'll mention that a little bit later. But a measly 27,000%. So who's getting access to all these opportunities? They seem pretty good, right? Let's just go through the list of people. Let's make it nice and easy. Retail investors, certainly not. You buy at public prices. Don't be silly. Institutional investors, they get to buy at private prices and sell at public prices. Typically the biggest beneficiaries. Underwriters, so your investment banks, they get a commission, a little piece of the pie, and usually a percentage of the total value of the IPO deal. The company, which is an interesting one, they do get a little screwed in the way of they could have just sold stock of the company at a much higher price. Let's say instead of pricing at 30, they could price at 90. This is money known as left on the table by underpricing their share value. But what it does definitely do is generates a ton of hype, ton of buzz on social media. And lastly, insiders, definitely some of the biggest beneficiaries and definitely the most deserving. I mean, these are the founders, the employees that are actually building and working on this product or service every single day. Venture capital and private equity, to be fair, also had to take an enormous amount of risk investing in these companies at very small valuations when nobody knew about them. They're really just investing in the vision. But either way, these investors are usually locked up for 90 to 180 days. In other words, they can't sell their stock or options until that time frame is up. And as we talked about retail investors, well, you can only buy the stock once it's public, so you're not going to get in at those cool price points. So in summary, you don't get to buy into Figma, a generative AI marketing platform that has 95% of the biggest companies in the United States as customers until after they open on the public market and triple. And you don't get to buy Bullish, a cryptocurrency trading platform that owns CoinDesk and is backed by a legendary tech investor in Peter Thiel, who has made a shit ton of money investing in tech companies. You get to buy in after the double. Now, if you don't sense my sarcasm, I'm being a little facetious here. I'm really just trying to hint at, these opportunities didn't take too much brain power to foresee some potential demand from investors. They're in extremely hyped up industry. I mean, we're talking about digital marketing combined with artificial intelligence and cryptocurrency, blockchain technology. So if that raw data wasn't good enough for you, the charts that were showing something like a 3,300% return annualized if you trade all these IPOs, then think about it if you only trade the biggest, the most hyped up, the IPOs with the most conviction in the craziest and most hyped industries. If we just use our brains and think about, hey, maybe a cryptocurrency trading platform backed by a deca-billionaire could do well on its first day of trading, maybe that would make for a good opportunity. Just maybe. Same thing with Circle in the blockchain industry. Same thing with CoreWeave in the AI industry. I mean, does it really take an Einstein level of intelligence or a deep level of thinking to think, hey, maybe these companies will do pretty well on IPO day? The average win-loss ratio of this trade, so just buying at the initial IPO listing price and selling when it opens on the market, that wins 70% of the time. The upside is so much better in practically every scenario. I mean, you can see the dots up here. The outliers are somewhere around 140 to 100%, whereas the outliers to the downside are around 40 to minus 30%, with the averages just being absolutely absurd. Remember, these are 1 day averages. You get the point. I'm beating the shit out of this dead horse right now. And now logically you're probably thinking, well, why wouldn't everybody do this? This seems ridiculously foolproof. There's pretty much no way you can lose. Well, there's one major flaw. There's never zero risk with any strategy. The reality is that investors, even private investors, that's right, don't get to pick and choose necessarily what IPOs they get access to. And even more so, don't always get to choose how much money they can allocate to each of these IPOs. Some companies only give shares to insiders, founders, executives. Some only give to institutional investors with certain areas of expertise or certain connections. It all varies widely. So what does this all mean? Well, risk management is essentially out of the question. This is John, the very cool and strong hedge fund guy. He wants to get in on the action. He just watched this video and saw, wow, this is an infinite money glitch. There's no way I can lose. And yes, you're right, John, but that's only if you can control your destiny. So let's look at an example. We have stock A, stock B, stock C. Stock A is an AI company, so you just know that company. I mean, come on, that's a no-brainer. That thing's probably gonna 3x right off open. You convince your managing partners, hey, we got to put a lot of money at this. We got to throw everything we got. We're going to put 10 million into this IPO. This company down here, well, they do crypto. Oh my God, crypto? Are you kidding me? That thing's gonna 10x. We don't have as much conviction, so we're gonna put 5 mil, half of what we did for stock A. And this one, this is a meat company. Don't even ask me what that means or what they do. But John has the same idea. He's thinking, nah, we don't really need to allocate a ton of money to that. Let's do 500K. So what's the problem here? Well, if we look at this stat, 31% of IPOs actually fall on their first day of trading compared to their offer price. Nearly 50% fall on their second trading day. Why is this important? Well, we already talked about how popular IPOs, ones that are, related to artificial intelligence, cryptocurrency, digital marketing, these are probably going to do well. Most people are going to be interested in them in some form or another. And that means because of their popularity, investors are more likely to be underallocated. In other words, our good friend John, he wanted to put 10 mil towards this AI company. Unfortunately, they only got filled for 100K. This company ended up doing great on IPO day and they doubled. They went to 200K. Profit 100K. Good trade by John. Good job, John. Stock B, oof. This one hurts. Unfortunately, this crypto startup ended up being a complete scam. Who would have thought crypto could be a scam? They had a lot of money in Fartcoin, and unfortunately, the dreams and aspirations of Fartcoin didn't come to fruition. They were able to get filled on just about half of what they wanted, so 2.5 mil. However, on the first day of trading, this thing dropped right to 2 mil. It lost 20%. Oh, sorry, John. That's just tough luck. That's going to be a $500,000 loss. In stock C, this meat company actually ended up doing pretty well. They sell this really premium meat that everybody wants to buy for some reason. They call it magic meat. They get filled on their complete request of 500K, and it jumps 50% from the IPO pop. Great trade, John. That's going to be a $250,000 gain. And as you can see, if we do some simple math, we have 350K and then a minus 500K. So overall, the intention was right. John had the right idea that an AI company, you can't go wrong with that. That money instantly doubled. The crypto company you got unlucky with took a fat L. And then the meat company was more of a shot in the dark. That also did well. But net, you lost $150,000. And this is because of a lack of risk management. John didn't have the ability to play this any other way. Destiny was not in his control. The simple conclusion is that it's not perfect because your exposure to each opportunity isn't balanced and you don't actually know how much you're going to be filled. And so theoretically, as we saw with John, you could just get unlucky. What you get allocated is mainly just a product of how many people are willing to buy pre-IPO pricing. If there's high demand, you're probably not going to get as many shares allocated. If there's low demand, for example, with Magic Meat, then you're probably going to get as much as you want. So exposure to these opportunities is very good on average. Obviously, we just saw that 18.4% on one day of trading, especially when we consider the context of, let's say, AI companies, cryptocurrencies. We already talked about that. You get the point. But still, that doesn't help us. We still don't have the opportunity to make this trade even if we wanted to, just to get any allocated shares, some skin in the game. Well, there is good news for us retail traders, and the tides are turning. Yes, that's right. Robinhood and SoFi, as far as I know, maybe a few others as well, I think Webull is one of them, is starting to provide retail the opportunity to get in at pre-IPO pricing. Figma, I asked for $10,000 worth and got $300 worth, but either way, I was allocated something, which I was happy about. In Bullish, same thing, asked for about $10,000 worth, received about $3,000, but still, I'll take any exposure to an infinite money glitch when I can get it. I can't complain. This is how the private investment world must feel. And many others are experiencing the same problem. We have this investor here who has allegedly $10 million with Robinhood, and they were allocated one share out of the $33,000 worth that they requested. So if this guy actually has $10 million worth of money in this brokerage, only giving him one share as probably one of the more higher end investors on the platform is pretty crazy. Now, there's probably a lot of things that go into this. I'd imagine the amount of time that you've spent with that brokerage probably matters a lot. I know one of my friends tried to get into bullish through SoFi, and he was allocated something like 1 or 2 shares, whereas I received 88. So again, I'm not exactly sure of what their algorithm is made up of or the various factors that go into who gets how many shares, but nonetheless, it is a step in the right direction. One day, I envision a world where one day the retail trader, the public trader, has access to the same opportunities that private investment does, at least the easy ones like IPOs, for example. Maybe not necessarily venture capital or private equity and investing in seed companies and at these really tiny valuations, but at least the bigger, hyped up ones. I think that's at least manageable on some scale. It doesn't have to be big. And I honestly think what you'll start to see is that the brokerages or the platforms that are more willing to provide retail traders with these opportunities are more willing to attract additional customers. I thought this example really brings the point home. Requested shares for bullish through Fidelity, Robinhood, Schwab, and SoFi, but apparently the only platform that actually awarded his shares at IPO price was SoFi. And so he's talking about moving all of his money from these other brokerages to the one that gave him this opportunity. Nice win here. So I think it just shows as these opportunities continue to present themselves, people are going to want in, and if the brokerage isn't providing that opportunity, then see you later. Go into another one that does. Now, we just talked about a lot, and I know this video is getting long, but let's just finish off on one last thought. Is this giving dot-com bubble vibes where you have these companies making no money, albeit growing, but making no money, going public and jumping, 100, 200%? Maybe. At the peak of the dot-com bubble, you pretty much just put .com in your name and your IPO would jump 100 to 600%. And if history is any indication, I know it doesn't repeat itself, but it often rhymes. If you start to see a surge of AI companies IPOing that make zero money and just have AI in their prospectus and their name, then it might be time to start looking the other way. I actually talk a lot about this concept in these companies in this video here. You should check it out if you're interested. But in conclusion, this dynamic between public and private investment probably is never going away, despite the hopes and dreams of many and the grand vision of having an equal playing field. It's probably not happening. That's just the nature of a capitalistic economy. We can see in the United States, for example, the net worth held by the top 1% and the top 10% is only growing and taking more and more of a share of wealth, while the bottom 50% of people are just struggling to catch up. That's 2.5% of wealth is held by the bottom 50% of the population. So I think it's just one of those times where don't hate the players, hate the game. Can we really hate private equity or venture capital or institutional investors for taking advantage of these opportunities? No, I mean, if you have a brain, half of these investments, at least the ones we just talked about, were as close to free money as it gets. But for companies in their early stages especially, there's a ton of risk that you take on just throwing millions at a company with a vision. No product, no service, just somebody who has a vision of something that sounds cool. There's definitely a lot of credit to be given there. But nonetheless, I think with at least larger IPOs, the playing field should become a little more level, giving retail investors the opportunity to buy in at these pre-IPO prices, the same way that high net worth individuals and institutional investors get to buy in as well. Now, I hope this video was interesting to you. I thought this stuff was super interesting. What do you guys think is going to happen? Do you think that these brokerages, namely SoFi, Robinhood, are going to continue to make this push for the retail investor? Is it even worth it for them? Are people going to start jumping around brokerages just to try to get access to these opportunities? Were any of you able to get in on the Figma and bullish action? I hope you were, because free money certainly doesn't come often. This is not financial advice. It's not actually free money. There is risk. All right, that's it for me. I hope you guys enjoyed the video. Please comment, like, subscribe if you're not weird, and I'll see you in the next one. Peace.